So 5 things you should actually avoid if you're looking to become a successful Forex trader. We're going to start off very simple, and this is over trading. I've seen it a lot recently where people are posting their prop firm accounts where they've actually failed, and you'll see 30, 40, 50 trades within the first week on their challenge account. I feel like a lot of these traders would potentially be good traders if they looked at the charts and were a lot more selective with the trades they were actually risking their money on. You'll see a lot of these setups will either be revenge trading, trades which don't actually fit the plan, whereas their actual plan could be a very, very profitable plan. And their strategy could make money in the long run, but because they have that pressure of trading funded accounts, they risk the trades, they overtrade to try and pass as quickly as possible. This is also the case with people that trade with personal accounts. They feel like they don't have enough capital, so as a result of this, they think that they should either trade more or risk more. With trading more, they'll make 2% on the trade, but they won't feel like it's enough because obviously 2% is a good trade. But because they're comparing themselves to other traders who might be making 2%, but their 2% dollar amount is 10 times the amount. So they see it as they're not making enough profit, so then they'll enter another trade, try and make another 2%, and continuously do this until they eventually go into a losing streak and end up in drawdown. Overtrading is probably the main reason why traders actually fail. They might have perfect risk management, but because they're actually taking too many trades and they don't understand their strategy long term and how many trades you should actually be taking per month, they actually fit a 10 out of 10 setup. They're just taking too many, which means they're just going to end up losing. And this kind of moves on to habit number 2 as well, or step 2 on things you should actually avoid. And this is to failing to adapt. If there are certain market conditions, let's say, well, my trading strategy, for example, currently GBP USD, the only pair I actually trade, is consolidating. So the way I trade is I follow trends. So I'm trading in trending markets. And I have to now adapt to trade during this consolidation. If I can't trade through consolidation and then we have weeks or months of consolidation, I'm going to be tradeless, or I'm going to not be able to trade at all. The best way to actually prepare for this from backtesting. So if you've backtested enough previous data, then you know exactly how to perform during these different market cycles. So you know that during consolidation, you might have to reduce your risk to reward. You might have to reduce your stop loss size or get different entries so that you're actually tagged into your trades. I see a lot of people trading during consolidation and now have these crazy targets, like a couple hundred pips down. They're obviously anticipating a break of the consolidation, but you need to trade in the consolidation. The way to do this is to adapt to the current market conditions. If you don't adapt to the current market conditions, it can lead to step number 1, which is over trading. You'll constantly be chasing trades, you'll be in a trade, you'll be in profit, it will lose, but then obviously because it's in consolidation, it looks like it's going to drop down again. So they get into it again, it drops down a bit, comes back up, stops them out. It'll just consistently stop them out over time, and they'll keep trying to trade back and make the losses turn into wins, leading to over trading as a result of not being able to adapt to the markets. And number 3 is overconfidence in your trading. This usually comes after someone has just had a winning streak, or in prop firm case, if someone has just passed phase 1 or phase 2 of their challenge account. And the reason why this is so bad is because the markets will definitely humble you and very, very quickly if you trade with overconfidence. It's obviously good to have confidence in your strategy, have confidence in your ability to actually trade and make profit. A lot of the times when people have actually passed a phase 1 challenge, they go into phase 2 thinking they're on top of the world, they're better than the markets, they can do anything, they can risk any amount, and they'll make profit. I'm telling you, this is when the markets are going to humble you. You learn more from actually winning than you do from losing. Because when you're winning, how do you perform? What did you do differently? And after a certain amount of time doing this, and if you are on a winning streak, for example, you're going to be very, very confident because you've just won 5 trades in a row, 7 trades in a row, for example. You haven't had a loss in quite a while, so you don't know what it's like to be wrong in the markets. And if you are eventually wrong, maybe this will lead to revenge trading, because you don't feel like you can be wrong because you've just won so many trades in a row and you're not used to seeing a negative trade on your account. This overconfidence can lead to revenge trading, which eventually ties back to overtrading to try and make back the loss. It can also happen with profits. So you make loads of profits and then you try to replicate the previous results you've actually had. So you're too confident, you think, oh, I made 30k that day, I'm good at trading, I can make 50k this day. So you're too confident going into the markets and you're not ready to actually risk that amount. You're not ready to make that amount, and you should just trade what's in front of you rather than trying to make as much money as you possibly can. And number 4, this is lack of risk management. The only way to actually save your account from blowing is by using risk management. And people that don't understand risk management will just be like, oh yeah, I risk 1% per trade. That's my risk management. But you need to understand, how much are you actually exposing yourself to in a week, in a month, in a year? You need to understand this, because if in 1 month you could potentially lose 20%, your account balance is going to go down 20%. If this happens 5 months in a row, you have a big losing streak, the account's gone. And obviously if you lose 50% of your account balance, you actually need to make 100% to actually get back to break even. So to understand risk management and drawdown, you need to understand, if you go into a losing period, how much do you actually need to make to get back to break even or get back into profit? And going on from this, if you are actually learning from your back testing, and you can see, okay, on average, my losing streaks were 4 trades. So you know, okay, 4 trades, I can definitely come back from this. And let's say in a week, you've had 4 losers, or you've had 2 losers in a week. You know that, okay, I could potentially have 2 more losers in a row. So I'm not going to start panicking. I'm not going to start over risking to try and make back the losses, because you know that you can expect 4 losing trades before you eventually wipe out any losses you've actually previously had. Kind of linked to risk management is risk to reward. So if you're actually losing trades and your risk management is perfectly acceptable, the winners will definitely wipe out any losses you've actually made. 1 to 3 is the one that I actually use. So you'll see a lot of my trades on 100k accounts will be 6k profit, because I risk 2%, I make a 1 to 3, and then I'm up 6k. Or on a 200k account, I'll make 6k or 12k, depending on the risk I'm actually using on that account. And moving on to step number 5, and this is the inability to handle losing trades, or basically to handle losing streaks. Because as a trader, you're never going to consistently win without having losses. You're not going to have a full year where you just win and not have losses. So what makes a trader is how they actually handle these losing periods. If you lose 3 months of the year, you'll be completely fine, as long as your risk management is in place. If you don't overreact from those losses, you follow the plan, you follow the strategy, you follow the risk management, because you know that it's worked from your back testing. The best way to actually handle losses is to have confidence in your strategy. How do you have confidence in your strategy? This is from data. The only thing to really back up your strategy and to back up your trading to give you confidence is by looking at your previous data. How has this strategy performed over the last 3 years? How has it performed during your 6 months of live testing or your 6 months of forward testing? It's been profitable in the long term. So why are you going to let 2 or 3 months that have actually lost affect your trading? By thinking like this, and actually having that mindset will make it easier for you to actually handle these losing streaks, and easier for you to trade like you normally would, whether you're winning or losing. You want it so that your trading strategy is a copy and paste. So whether you've lost 5 trades in a row or you've won 5 trades in a row, copy and paste, same strategy over and over and over again. The more simple it is, the easier this process will actually become for you. Again, people's strategies are different, so there's not a set way to actually do anything. If you want to be a profitable trader and you follow these 5 steps, then hopefully see you at the top.